Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with co host Walter Dial. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable business value, protecting sellable business value, and for planning your eventual exit from the business. We want to help you build a business that's sellable or transferable, and then help you exit successfully on your own terms and conditions. And a successful exit absolutely requires the right tax planning. Without proactive tax planning, your exit could trigger a combined federal and state, depending on where you live, hit of 40 to 50%, and maybe more. Uh, but with strategic tax planning, that liability, that hit, can often be reduced significantly. But you got to do it, and you got to do it well in advance. And so, given that a business sale is often a once in a lifetime liquidity event, tax planning isn't just a nice to have, it's the primary driver of your final walkaway number. A tax smart exit, that's our topic today. And our guest is our friend Ed Cotney. Ed has a national reputation as a tax strategist. He's a family wealth counselor, certified exit planner, author, sought after speaker. For more than 2 decades, Ed has helped business owners and high income professionals legally reduce income taxes, protect their accumulated wealth, and then exit their businesses with minimal tax exposure. That's what he does. And his latest book, Tax Smart, has just been recently published, and and so we're excited to have him with us today. We love Ed. He's very smart. He's tax smart, and he's a smart guy. So Ed, great to have you with us today. Thanks for taking the time. We really appreciate it.
Well, hello, Pat, Walter. Great to see you guys again. And it's always fun to get back with folks. We first met many years ago in Denver, Colorado at a conference. And it's always great to get back in touch with you. And thank you about the book. The book has been a huge success. This is the book two in a series of four that we're publishing. And so book one was about income tax planning. This book is about exit planning. The next book is going to be about wealth transfer while you're alive. And then the last book is going to be about how to build enterprise value in your business.
Well, great. You know what? You just answered my first question, which was how is Tax Smart different than the other books that you've written in the past? Is there anything else you'd say about that, though? Anything else that you'd say about the difference between Tax Smart and the prior books?
That's the big question right there, Pat. As we know, most business owners don't know when they're going to retire, but they like, well, I'm going to be age 65, or I'm going to pick a date in the future. With the number of private equity groups we have today and the amount of money out there, we have so many unsolicited phone calls to us to a business owner, and when that business owner gets the call, if it's on the worst day of the year, and somebody saying, "Hey, I've got people interested in your business," the next thing you know, they're selling the business at 54 years of age because they're done. And there's a lot of reasons why a business seller will move to the sell stage versus I'm just going to keep working. Everything's working right. I love my business. I love my employees. It's a great relationship. But sometimes that day comes along where you need to sell for a variety of different reasons. And so we decided on this series of four books. The first book, Tax Freedom, is really for the business owner to do a better job of their income tax planning and to put things in perspective for the business owner. If you're in a state like New York, Illinois, California, where once you get to be about $1 million of income landing on your tax return, you're pretty much in the 50% tax bracket at that point, state and federal. So think of it like this as a business owner. Why is income tax planning important to me as a business owner, even if it's just for the next 6 months or 6 years? If you can reduce your income tax bill by 25%, okay, just reduce your income tax bill by 25%. Do you realize that's a year of free profits every 4 years? And I share that with business owners to help them think about how much time do I spend every year working on margins? How do we reduce cost? How do we increase profits? When we think about the time as a business owner that we invest in the company to make it more profitable, but yet we spend about maybe 12 minutes with our CPA, and it's typically where do I sign and how much is the check I got to write? We've got to do a better job of using our tax professionals from a proactive point of view. And I challenge business owners all the time. Ask questions where, why am I paying this much in tax? What are things that I can do to help reduce this? I've already bought all the trucks I can stand. We've already expensed everything possible, and I'm out of options. And I funded my 401k or deferred comp or whatever, and I still have a big tax bill. Keep asking questions because somewhere in there is going to be some information or an advisor that can help you do this. And so I try to get business owners to understand the only one that cares about their tax bill from an income tax perspective or when they sell their business is them. They've got to quit thinking that the CPA, the attorney, the financial planner, the life insurance guy, the banker, the guy at the 7-Eleven store, they don't care about your tax bill. You have to be in charge of your tax. And just like you said, as we teed this thing up, when I sell my business and I'm going to lose a third on a good day. Oh, by the way, there's might be some broker commissions in here of another 6 to 10%. So now we're not talking a third. Now we're talking 40% of my business gone in cost. And now I got to somehow live on 60%. These are very important things, Pat, that you've identified that if you can reduce your total cost or your loss on the sale of your business, what's it worth? I mean, if you can save $1 million on your transaction in your business exit, how much time would you give me to be learning about tax strategies to get that benefit in your pocket?
Yeah. So here's what I want to do. I want to get into some just general scenarios. And what we like to do here on this podcast, Ed, you've heard it before, is we like to provide listeners with a few practical steps that they invest 30 minutes here listening. They can leave with two, three, four things that they can really execute on. So let's consider a few scenarios, just general, and have you provide what you think would be a tax smart action or consideration for that particular scenario. Does that sound good?
That's a great idea.
Okay, well, let's start with third party sale. Let's say third party sale, baby boomer, had the business 30 years. It's a service company. Um, has kid in the business. Kid doesn't want to have anything to do with it. They're going to sell to a third party. He is absolutely decided. We've helped him decide that he's going to sell to a third party, and he wants to do it within 3 years. How can that owner, he or she, be tax smart in planning that transaction? Give one, two, or three things that person should be thinking about.
That's a great question. If I'm 3 years out from selling my business, the first mistake we don't want to create is we don't want to go out and get an appraisal or evaluation done on the business because when you go into the sales process as part of the due diligence of the buyer, you're going to have to surrender all these appraisals and valuations that you acquire so that the buyer can do their due diligence to figure out what is the value of your company. The reason why I tell business owners not to order that is because it becomes a mandatory thing to surrender. Now, if your appraisal comes in and is perfect or better, fantastic. That's not a mistake, is it? But overwhelmingly, a business owner thinks their business is worth more than what the valuation actually is. And at that point, they're like, golly, now we've got this valuation, a record that is now required to be used in due diligence down the road. I may be shooting myself in the foot. So here's a way around that problem. Ask your attorney to order the appraisal. And the attorney, under attorney client privilege and work product, he orders the appraisal. The appraisal comes in. The attorney and the client review the appraisal. And if that thing is a disaster, thank goodness the attorney has that as his work product. It will not be surrendered in due diligence for the sale of the business. Conversely, if it comes back perfect, print out an extra 100 copies, stand on a street corner, and pass them out. So that's a very big piece of the puzzle here that's important because when due diligence get here, we want due diligence to be working for us. We want to be in charge of due diligence and we want to make certain the processes, procedures, the culture, and all those things are perfect. But if I've got a bad appraisal from 2 or 3 years ago, and even though I've worked hard over the next 2 or 3 years to get it better, it's still going to be ammo for the buyer to use to whittle down the value of my business when that sale comes along. So that's one important thing. And in the new Tax Smart book, we talked about that in chapter 5 and 6 of how to use the attorney and the appraiser in the way. The second point that goes hand in hand with that appraisal being done is I asked the appraiser to bifurcate both the corporate and the personal goodwill of the business. Remember, when we sell our business, overwhelmingly it's going to be an asset sale. Occasionally we get a stock sale as an S, but most S corps and LLCs taxed as S will typically be an asset sale. Okay, and so with that process, when we get all this attorney thing going on, and we understand that we protected everything from that perspective of giving it to the buyer, we're in a good situation to where that appraiser, if he bifurcates the goodwill, that gives me more tools to create tax efficient exits. And so the reason bifurcating personal and corporate goodwill is because when the buyer says, okay, I'm 6 months from going to market, I've got a broker identified, we're getting things ready to go, the appraisal has this much as personal goodwill. Well, I can allocate that personal goodwill into charitable trust structures, which will bypass capital gains exposure, get outside of the taxable estate for the seller, create an income tax deduction, and create an income stream that's going to be subject to cap gains and income tax for the rest of the seller's life. In other words, if instead of me losing two, three, $10 million in taxation, even if I just had $3 million in personal goodwill and I allocate that to a charitable remainder trust, that's $3 million that's not going to get hammered. That's a big deal for most people. But when I don't have the personal goodwill properly bifurcated in the appraisal document, then we have to go back and do the appraisal again to bifurcate that. And so I would say that when you order your appraisal, and this is chapter 6 of the Tax Smart book, make certain the attorney gives the instructions to the appraiser to bifurcate that goodwill. Now, sometimes you may have no goodwill, that's personal, but if you do, that's a powerful tool for us to work with. And third thing, Pat, I would say if we're just going to whittle three things down that are so important that buyers just don't understand, because like you said in the beginning, this normally is the one time you go into market, which is the largest financial transaction of your life and largest tax transaction of your life. When we think about that process and we think about the deal itself, overwhelmingly the buyers are going to be borrowing money to buy your business. Okay? Overwhelmingly, the buyer is going to do a leverage purchase. And no matter where that buyer goes to get money, the first thing that lender's going to ask for is a quality of earnings report. And time again, I will see the business owner go, I don't want to spend money on a quality of earnings report. You don't have to. I like a quality of earnings report because one, it helps validate that your appraisal's right on point. Two, it gives you the ability to have the quality of earnings report ready to go. And overwhelmingly, the sellers are in a position where when the buyer comes along and go, well, here's the QAE are ready to go. You will save 2 to 6 months time in your transaction because you were serious and ready about going to the market, and you made it easy for the buyer to do this acquisition. That's what the seller's got to do. Control that appraisal exposure, get the information protected, get the appraisal done right, and get a quality of earnings report. Yeah, quality of earnings report costs a couple of bucks, but it's an investment in the sale of this practice or this business. How's that for three?
That was excellent. That was excellent. Hey Ed, let's take that same scenario, but let me add one other feature. Let's say that the business owner um, is very strongly inclined to give a hunk of the proceeds to charity. What steps should they take ahead of time in order to reduce their tax bill?
One thing I
What are
tell
some options?
great question. So the first thing we want to do, Walter, is we want to prove beyond a shadow of a doubt that the seller has a philanthropic intent that has been recorded as evidence. Let me preface why. I have a little short email string, and Pat, I'll send you this email where, dear attorney, CPA, financial planner, if I ever sell a major financial asset in my life, such as my business, I plan to integrate some form of charitable tax planning strategy. Why is that important? Well, it's a big deal. Sometimes people get into these transactions and they see the tax bill and they already got a letter of intent done. Maybe they're in PSAs being done. We already have escrow dates identified, and they go, oh gosh, I'm very philanthropic. I want to support my church or favorite charities. Surely there's something I can do last minute. Not so fast. Remember, the IRS has rules about the timing of repositioning assets for charitable tax planning purposes. We got the Ferguson case and a couple other cases on point here where the IRS denied the charitable income tax deduction because, in the eyes of the commissioner, they felt that the only reason the seller was doing something philanthropic last minute was to do tax planning to mitigate that. By having this email in your at hands of your attorney, your CPA, and your financial planner, and half the town if you want to, you have just created an evidence so that when the IRS says you don't have any philanthropic, well, it just so happens 14 years ago I sent this email to my CPA and my attorney. I have a philanthropic intent, and even though I may not have donated giant sums of money or stocks over the years, when I sell this one major asset of my life, I plan to integrate there. So you want to take that argument away from the IRA. Again, I'm back to control. So using that is a great thing, Walter, to be able to do this. Now, to get into something, again, we want to be early with the client to start teaching the client what are the tools that align best with the exit. For example, if somebody said, Ed, I've got a client, he's 35 years old, he's selling a business, and he wants to use a charitable remainder trust as part of his exit. That tax deduction is going to be terrible because he's too young. Whereas somebody who's older, the charitable remainder trust would probably bring a better tax benefit to the table. So the very common charitable remainder trust may not be the primary choice here. We may want to go to a pooled income fund or a donor advice fund if we're just trying to do an outright gift or something. Here's the thing, Walter, that I will tell you that I have, and you probably see this all the time too. Most business sellers are so busy, particularly when they start getting close to the transaction, that when we try to help them understand what these tools are, they're too busy to learn. And we end up not being able to do anything because it's last minute, just hurry, hurry. There's this roller coaster thing going on with the buyer due diligence and my family life and everything, and dealing with the company and getting the employees aware of the fact that we're getting ready for transition. Oh, by the way, here's how we can solve a $3 million tax bill. I ain't got time for it. I'm sorry. I can solve a $3 million tax bill, but I need time, and I need time with you to educate you about what tool is best. And so, Pat, that is one of the best secret sauces we have in here for you and Walters to help people understand. You have to invest time and energy in understanding the tools. You may never use the tools you learn about, but there are commonalities within the tools that you can start going, well, this is kind of like that over there. And maybe this works better with my particular company. How's that, Walt?
Yeah, that's exactly what I was looking for. Because we've had situations where clients, and not so much with Ennis, but back when I was at GRF, clients are famous for showing up and saying, "Hey, guess what? I just sold my business." So now, they can still make a nice charitable contribution, but they've really missed opportunities, like you said, with the trust to maybe get a lifetime income stream going, or just to avoid the tax in the first place on that portion of the appreciation. So yeah, that's exactly what I was looking for.
All
Thanks for
right.
answering.
Hey, let's move to another scenario.
Well, let me hit one thing real quick. Walter just hit the magic button right there.
Okay.
Business owners ask me, why is it important to do an exit planning strategy on the front side versus the back side? It's a 1 to 3 ratio. For every $1 on the front side, I can solve $3 problem. When it's behind the transaction and I'm trying to solve this after the fact, it takes me $3 to solve a dollar problem. So the efficiency and the effectiveness is on the front side of the transaction, not the back. So you can still do something good. It's just not as good.
That's good. I like the way you put that. I'm going to remember that. That's going to be a
Three,
takeaway.
3 to 1, 1 to 3. Yes, sir.
1 to 3, 3 to 1. That's good. Okay. All right. Another scenario. Let's do, you know, family transfers. We've got a few of those going on. Let's talk about that. Yeah, kids in the business. One kid in the business. Let's say three kids out of the business. The one kid in the business is showing, yeah, they're going to be. They want to be an owner, and they've been evaluated and assessed, and they seem to have the skill set to be a successful owner. So the business owner is going to move toward family transfer over the next 3 to 5 years. One of the big challenges is we're figuring out or helping the owner think about their transition out and what their role is going to look like and their life after the business so they're not miserable and all like that. So it's going to be gradual. And that's, I'm saying that because most of the ones we work with at family transfers, they're they're gradual, just like the ones you work with. So what about that? How can those folks be tax smart?
There, whenever you're going to do an inside transfer, a lot of business owners want to do it, but sometimes the numbers just don't work for them. So when you can get this to work, it's always because of proactive planning, a good team around you, a good child or children to be able to work with. So some of the technical things we have to balance as planners is how do we move ownership interest to the child in a manner where mom and dad keep the control they need so that we can effectuate a wealth transfer that works well. So this is where you'll hear things like discounting models using family limited partnerships and things of that nature, the annual gifting model, being able to transfer X amount a year to the kids, being able to run the books so that the money we move the kids, we can deduct over here. So it takes time to do that. And so it's one of those things where when people say, hey, I want to transfer my business to the kids, is this something we can do in the next week or two? In the next 5 to 10 years, maybe, if you want to do it with any efficiency and control. And so you're right, when we're trying to transfer a business internally, it takes a lot of time. There's a handful of different ways to get there. I've even seen some pretty good models where people overfund life insurance policies on mom and dad. This way, there's an abundance of money sitting here. This way, when the business is transferred to little Johnny and little Susie, they don't have this burden of having to pay mommy and daddy back this heavy load because mom and dad were able to max out deferred comp defined benefit and overfund their life insurance policies. This way, they're able to have plenty of money to support mom and dad, and the business is able to support little Johnny and little Susie. The other thing that's really important here is we have to think about, when I transfer the business to my kids, if they're married, if there's a divorce, all those things come into play here. So, how do we make certain this transfer is done in a way to the children that if something goes wrong with the child, maybe they're in a car crash and ends up in a great big lawsuit or something, we have to put those protectors or guardrails around the transfer of the business to the kids. It's not just a tax planning strategy, which is a big deal, but it's an asset protection play is just as important when we're doing an internal transfer.
Yeah, I think it's interesting how much of the planning around internal transfers is not necessarily tax planning. I mean, I had a client who just the exact scenario Pat described, and I think the father owned the company. He died like in the summertime, left it to the one son who was running it, but he had three siblings who each owned 25%. And by Thanksgiving, they weren't talking to each other.
Yeah, there's a lot of coaching required here. And one question I get a lot is, how do I train my kids for the wealth transfer? Whether it's business or other assets. Probably the best book I've ever read on this is by a guy named James Hughes, Hughe. It's a Complete Family Wealth, second edition. It is a fantastic book. He doesn't start talking about here's how family limited partnership works and stuff like that. He comes from the perspective of from a culture, from a family culture. How do we help our children understand the affluence necessary to run this business and what's going on? Because I think we all three agree here. As business owners, one of the most powerful things we can do is create jobs. I mean, creating jobs is one of the most important things we can do with our time, talent, and treasure. And we want to make it so that this beautiful business that we've created, if we're transferring it internally, we want to equip our kids, the leaders of this new company, to be able to run that company into the next generation. One of my clients right now is on Gen 4 of his business that his grandfather created in 1921, and and actually in the tax smart book I had him contribute a chapter about what all things do they have to do generationally to prepare things, and now we're working with Gen 4 to get them prepared to take over the reins. So there is a decent amount of tax planning that goes on there, Walter. You're correct, but the psychology of moving this business and how we get the kids to take control and ownership in the right way is so important, and it just doesn't get enough. It does, in my opinion, the soft stuff does not get enough attention.
Yeah. Hey, let me change gears a little bit because in your first book, You talk about choice of business entity, which at the end, when you go to sell your business, that's that's a critical factor. So, do you mind just sharing your thoughts about how you think about what business and what type of entity makes the most sense and what you see as optimal?
That's a great question, Walter. In fact, some of the points that I get occasionally is that, yeah, we're going to start a business and we're going to go set up an LLC. And I'm like, well, did you check your Secretary of State's office to see if an LLC is allowed for that particular business to be set up? What? Well, I went online and I found a company that can do my documents for $99. Okay, great. I'm glad you've got that business entity, but if it's not allowed in that state for you to be an architect or whatever, you may be in a situation where you may not have a business entity that's in an asset protection role. What I try to tell people is, one, you want to make certain you hit all the bells and whistles of, do you have the right structure authorized by your Secretary of State? Number two, what is it that you're going to deliver? And this is where you want to start running some projected tax returns with your tax professional to go, which one of these things makes sense? And the one thing that I will tell you that, from a personal perspective, I was anti C Corp for years, man. C Corp bad, double tax, triple tax, quadruple tax. I mean, C Corp bad, bad, bad. And the rules changed in 2017, and I didn't know it. It has nothing to do with TCJA, but there's a point in time where you have to step back and go, wow, those rules changed significantly. And should we be a C Corp? And I will tell you that most advisors, when I'm doing continuing education for attorneys and accountants and financial planning, I'll ask the question, how many people love C corporations? It's a short list of hands that go up. It is more complicated, but the tax planning opportunities there are just through the roof when you need it. I like to bring C corps out when I see more than for married filing joint, more than about $800,000 landing on the tax return. That's when you'll run a parallel flow through and a C corp. And so there's some significant things you got to play with here. But when you have a client who's maxed out everything they can do, they've done everything normal, funding their hours, 401ks, et cetera. Then we have to ask the question: are we just stacking income for tax at this point? Because if you're making $1 million a year and you're living on 400,000 in California, you're stacking about $300,000 here into taxation that you don't need. Whereas if we had parked that into the C corporation to flat tax at 21%. So anytime you can have your personal tax return down to 24 and you can have your corporate tax rate at 21 and run that balance, that is a very effective optimization. But most CPAs don't want to do a C corporation. But again, a C corporation is not for everybody. And so business entity selection is a big thing to ask before you pull that trigger.
Yeah. So, okay, Ed, as we start to wrap up, what is there anything that you came into today's conversation with thinking, I want to say this that we haven't asked you about? Anything that you think is important, anything that you think is going to be a great takeaway that anyone listening can just take it and act on it? Any words of wisdom before I ask you for your contact information?
Yeah, Pat, when we wrote the book, Tax Freedom Book for income tax planning, and then Tax Smart Exit for exit planning. Um, Initially, Tax Smart Exit was only 17 chapters, and I just didn't like the way it was ending. It was chapter 17 was a fantastic chapter where we're using slats and idiots and deferred, 453 structures and stuff like that. Chapter 17 was one of the few times we pulled everything together, because what I did with all the contributors, just write on this one topic, don't add anything to it, because I try to help people learn from a silo perspective. What does this tool do? Understand this tool before you start learning about another tool and trying to blend them together. Okay. It just didn't land right. So I'm like, we really need a good exit chapter here. So chapter 18 is basically how do we avoid deal disasters. And then I turned that into a single front and back page that I sent to you. And I would encourage all your listeners. It's a short 7-point scenario of what are the things I need to be doing right now to avoid deal disasters that can help me get ready for selling my business in 2 months or 6 years. It doesn't matter. But what are the things I can do right now? And that's why I want Pat to be able to distribute that out to you guys and just take that and look at it and try to apply it. The other thing that I recommend that the sellers do is meet with their CPA every couple of years and have this discussion. If I sell the business today, what's the numbers going to look like? What's my take home? Take that data to your financial planner. This is where we want to start talking about, okay, if my net with no tax planning is going to be this, is that number going to be enough to support the lifestyle that I want for my spouse and I? And so you have to start thinking about this stuff. And then you start going, well, that's not going to be a good number. How do I increase the value of my business? What are the things I got to do to make the EBITDA work right? What are the things? And so when you figure out what your lifestyle needs to be, you can reverse engineer this with your CPA and your financial planner working together to kind of run the numbers. And then when you start getting ready, do your homework on your business broker. Find a business broker who has experience with your industry. It's kind of like bringing the guy that's really good at selling barbershops, and he's going to be over here selling a car dealership. It's not necessarily the same thing. So you want to look for that industry professional as a business broker to help you walk through this when you're doing an outside sale. And so I really wanted Chapter 18 to be a good summary of these are steps to take. And that's why I went ahead and took Chapter 18 and turned it into a little sheet like this to hand out, because you don't have to do it. And I'm a terrible reader. I hate reading all day long. So both Tax Freedom and Tax Smarter and Audible, you can get them on Amazon and Walmart and iTunes and Spotify. You can get them anywhere. And it's a great book. All money from the books go to charity, so there's no proceeds going to anybody whatsoever. And we're having fun with this thing, but you're exactly right. A business owner has got to be thinking about selling his business every single day. I mean, because divorce, bankruptcy, litigation, you name it, can happen at any moment. And when you're not ready and you're not prepared, you're going to have a huge tax consequence that could have been avoided with just a little bit of planning and getting your team to work together.
Excellent. Those are some great thoughts. That's great closing thoughts right there. Thanks so much. This has been hugely helpful. Yeah, listeners, if you want that sheet that Ed just mentioned, just contact me, email at nslp.com, and we'll get it out to you. And Ed, if someone wanted to contact you directly, how would they do that?
Real, real easy. My business is olympustax.com. And of course, my email is ed@olympustax.com, and my cell phone is 530-913-0562. I am in California, so I'm 3 hours behind all you guys on the East Coast, because I get a lot of East Coast phone calls. It's just funny how the phone rings, and it's like, early in the morning for me. They're calling like at 5 o'clock in the morning. Well, it's only 8 o'clock for them. They're happy as a clam because they've already had breakfast. I'm still trying to find the rooster to get him to start crowing. So 530-913-0562, olympustax.com.
Fantastic. Fantastic. And listeners, if you want help in maximizing and protecting the value of your business, or for planning that eventual exit, that's inevitable. You're going to exit. We're 100% sure of that. Plan in advance, not just tax strategy, but everything else too. Contact us at Innis Legacy Partners through our website at nslp.com or exitreadiness.com. And thank you for listening. If you've benefited from today's conversation, please consider liking it, sharing it on social media. And until next time on the Exit Readiness Podcast, this is Pat Ennis and Walter Dial signing off.